Ladies and gentlemen, the Asset Capitalist Show, live, anyway, from St. Bart's. I'm in a new lair. It feels like Ian Fleming in the Goldfinger Villa. Keeping it real, a little bit old school. But I'm back. The world tour is over. 2 weeks on the road with my Gia Da. Boston. We put that video out on the podcast last week. Thank you so much. Lots of people watched it. I think you kind of got I watched it and I thought, like, that idiot looks as if he's on cocaine. But looks like you guys enjoyed it. Thank you very much for your precious comments. Thank you very much for the liking. Remember, as we like and leave comments, it is our chance to hack the damn machine, get the algos taking us out of the box so that we can try and wreak havoc on all the suits and try and take down the frizz. Did we just see, can I ask you, did we just see a reverse Bernie Madoff? Bernie was the ultimate insider. He wore the most refined suits. He glided when people walk, he glided. You would trust him with your family's money. Did we see a new strategy? The kind of, I mean, I tried it, but this kid, what's he called? SBF, forever after this week, ever standing for stupid bloody fucker. How do you vaporize 30 billion, 30 yards of wealth? Well, live in the Bahamas, says the guy who lives in St. Bart's. Was it a reverse Bernie Madoff? Was it in the crypto world, you give money to the Trump? Same outcome, unfortunately. Maybe we'll discuss that. Don't have the alchemist. My re-entry onto the island, I've been fatigued and disorganized. Surprise, surprise. Anyway, I'm going to attempt to try and read the mailbag on Twitter, kind of ask me anything format. Let's see the chaos which results. Will Celtic win the league? Are we discussing the Celtic Football Club, that is soccer to our American cousins, the current champions of the Scottish soccer leagues? I suspect they will. Very well financed and leading in the championship by 7 points. But who cares? Scottish soccer is boring. What is money? Damn. Actually, I'm saying damn because people have been asking me that on the road. I mean, when the hotel check bill comes, I've been like, what is money? Simply the price, the admission for the Theatre of Dreams in particular. Wonderful locations in London. What is money? Money is a means for paying things. Money. And the key juice of money is the ability to pay off debts. You can't pay off your debts, you ain't got money. And I think, again, our young frizzled SBF friend is discovering that his concept of money was kind of at least 5 or 6 yards, 5 or 6 billion kind of off center, and being unable to meet his commitments has resulted in a reversal of fortune. So money is the ability, money is this mechanism, this medium to repay your debts. Think about Japan now. When you say now, is this now? Is this? Are we now? Is the reference point for now the fact that the stock market went up 5% in a day? Is that the reference? So have we now? Are we delineating the spectrum of time, and now it's to be separated into little quadrants or bookended by short covering? I do appreciate. I did see someone put out that I think on 22 occasions when you had such a move, risk assets were higher. Yeah, big deal. There are lots of statistics like that. Most veterans of risk trading will tell you that price volatility, enormous price gyrations tend to characterize bear markets. I recall the day it was September 2008. I thought I was over. I thought I was finished. I thought they'd caught up with me. For 13 months, I had carried the heavy burden of recognizing that the financial system was kaput, but politicians and their ilk were determined that that news not be shared with the wider community. And I recall a day coming back from the Morgan Stanley European Hedge Fund conference where they try and bring investors and managers together. And it was quite prophetic because it was in Greece, but late summer, and it wasn't a hurricane, but you couldn't go outside. Parasols were kind of getting pulled up, a bit like going to Oklahoma with the Wizard of Oz. On the way back home, I recall there had been an announcement to ban short selling. Yeah, let's ban the truth. No one can find out how bad it is. And I think on a melt-up day, why did stocks explode to the upside? Because there was an overwhelming need to cover financial short positions obligated by the authorities. And I think that day I lost 22%. I thought that day I was over. And yet within 3 weeks, Lehman Brothers had been consigned to the dustbin of history. So now is today. It's got nothing to do with yesterday. And with regard to Japan, I mean, are we talking about the yen? If we're talking about the yen, we might be talking about treasuries. But let's see if there's a question on treasuries to come. Gold. What do I think about gold? Well, I recall, where was I on Sunday night? I was spinning some discs. I remember I was tweeting about Blondie, the Blondie rap, the man from Mars. There was a bright light. I tried to escape, but the man from Mars, he shot me with his gun. He ate me. I ended up in the head of the man from Mars. What does the man from Mars do? He eats cars. He eats Lincolns. He eats Cadillacs. He even eats Subarus. Anyway, enough silly nonsense. But I recall that evening somebody saying, wow, have you seen gold? Gold was up big time. And I was like, ask me tomorrow. Now we're asking me at the end of the week. And that movement in gold has continued. What do I think about it? Gold is fine in terms of a very long-term perspective. If we look at charts, gold has had a correction. Corrections are what happens when you're carrying risk. But the uncertainty revolving around gold is the direction of real rates. And that's largely, again, determined by where treasuries are trading and how much of this inflation that is coursing through the economy, how much of it will be retained after we endure what looks like being a rather severe, nasty downturn. Back up a little bit, just to protect my fragile ass. This is not financial advice. I am sitting in St. Bart's in a trunk top wearing sunglasses. Okay, so this is not financial advice. This is simply I'm riffing on the vibe of finance. This is unedited, spontaneous combustion of thoughts, hopefully passing through the experience filter of the last 30 years or so of Mortal Kombat engagement with financial markets. So please, I'm not daring you. Hey, do what the crazy guy says. I'm simply seeking to entertain you, make you think, not make you invest or make you disinvest. I happen to have a very soft spot for technical analysis. What is technical analysis? Technical analysis is the production of charts, lines. I preferred the graphics of Japanese candlesticks. I love the notion that with everyone obsessed by how we are so much smarter than the generations that came before us, that actually you could attempt to apply the technology of the 16th of the 17th kind of century when Japanese, I like to think of them as Japanese samurais, but they were rice traders, and they were simply trying to engage and graphically represent the kind of monkey mind of the market. Yes, I believe it. No, I don't believe it. Again, we're talking about the now. We're kind of suggesting that because we had a monster up day in markets, that all sins are forgiven. These charts are kind of rather helpful in that determination. We were kind of considering gold. Gold had a junky pullback. Its price has been falling. If we were to measure trend, one of the challenges of technical analysis is the trend. How do you define it? How many observation points? I prefer lots of observation points. If you come in too closely, and coming in too closely and narrowing your focus is an error of judgment, which I believe the Federal Reserve makes. Not that they're looking at charts, but they're looking at a confined space within the monetary disorder of the world. They're actually looking at the one part of the monetary world which is not disorderly, is sound asleep. But with charts, there is no wisdom. It's a plaything. It's trying to coach curiosity from your mind to ask questions. To my mind, it's sheet music, which kind of put me in a more acceptable state of mind to consider narrative. And with narrative and storytelling, I could go on and have the audacity to conceive of a contentious premise that might just become accepted by more people than yours truly. Do I consider myself a trend follower? Yes. One of the fun parts of my mission was the belief in being not a moron, but being an oxymoron, in that I was a trend following contrarian. But again, the trend is the biggest risk issue you have is how far does the risk asset price have to fall before it takes out the trend. And again, it's timeframes. So the 10-year US Treasury, the yield or the price, are instructive in this, because the yield over the course of the last 2 years is backed up from 50 basis points to a peak, I think, of about almost 450 basis points. But I think it got to about 4.4%. But that's 2 years. And I mentioned and given reference to treasuries being like tentatively kind of crossing a minefield, being in the killing field, that any further price weakness in this territory could wipe out the long-term trend. So, if you will, trend analysis is the siloing of different intertemporal points, and it depends how often you wish to engage to trade your portfolios. How many people, especially how many professional traders who find themselves with I was going to say the rigor, but the bore of a mark-to-market daily, weekly, even monthly, how many can go back to the beginning of the Treasury bull market in 1982, so 40 years ago, and say, well, you know what, I'm going to, and I think this is a fair point. If your reference point is 1982, we're right on the axis of the very long-term uptrend. But as a professional investor, you're too late. You'd have to have engaged in shorter time frames, in conceiving of engagements or disengagements with the market. You can't sit there and have a security which you're long of, have a yield go from 50 basis points to 450 because you're dead. So there are no quick fixes in terms of technical analysis. I want to say nothing works, but I favor it because it's in the realms of, I don't want to say silliness, but it provides a levity to the very serious business of this, what I call the arrogance and the conceit of conceiving of investment recommendations. Like, for sure, there's a huge amount of intellectual analytical time given over to reach these decisions, and you can be actually held hostage by the enormity of the intellectual exercise. And it doesn't matter how smart, and it doesn't matter like how cool your spreadsheet was, you're kind of none the wiser. And so I like adding it to the Japanese samurai guys and the trend and bringing the two together. Nothing is perfect. These are simply mental exercises in trying to reach and obtain a creative zone that gives you the audacity and sometimes the merest glimpse of things which have yet to happen. Are there any go-to measurement periods in the calibration of charting? Again, personal preferences. I have to tell you that back in the day, I was trained by a wonderful chap, Brian Marber, deceased, unfortunately, no longer with us. Wonderful character. And he laid claim, I can't substantiate this, but I've got nothing to doubt it. He laid claim to having been the first, or amongst the first managers within the vicinity of London back in the 70s to have actually gained an account with the specific assignment to be managed on the basis of trend analysis. And he wore a bow tie. He was quite a thespian, and his stories were legend. And from him, he tutored me to use, I'll never forget, 21, 63, and 252 days. So 21 is your month, 63, 3 months, 252, the trading days typical of a calendar year. But again, I always had if you will, I had the dagger, which was these short intertemporal displacements. And then I had the samurai sword, which was much further back, much slower moving. And on that, I liked symmetry. And I couldn't possibly defend logic. This is illogical, but I liked 20 and 40 month moving averages. I believe that whatever correction is going on in risk asset prices, that we will have to see Apple, the share price of Apple, reach the 40 month moving average to be a indication that a lot of the fictitious wealth, right? Fictitious wealth sounds conspiratorial. It sounds as if there have been agents deliberately setting out, rogue agents deliberately setting out to steal or to misrepresent. What I mean by fictitious is not that. I mean that there are periods in the history of time when money is so widely available that having access to it makes risk takers ebullient with regard to the future, and perhaps they overstate the possibility of the future. And that creates the fiction or a fictitious level of valuation that I think we came to see in the immediate year or so, and certainly arguably a few years preceding the COVID pandemic crisis. For Apple being a darling, being the first $3 trillion market capitalized stock, I believe, certainly the first proper stock, not one of these quasi-sovereign stocks like you see with the oil stock in Saudi Arabia. It's the sacrifice of the virgins. You've got to Like for me, I'd rather see the great darling laid low and trading on the 20-month moving average. The 40-month moving average would be an indication of that. I think it traded 20, and I think I'll try and find that chart and we'll try and post that. I believe that the 40-month, I think Apple, the share price peaked. I surf in St. Barts. I do yoga in St. Barts. I do not have a Bloomberg terminal. But I want to say that Apple peak share price about $193. I think the 40-month move, the 20-month moving average would be like 140. I think the 40-month moving average would be closer to 100. So a halving of Apple really clearly, I think, would demonstrate a lot of compression in the fiction that we had endured about the future. I think the question is valuations. What do I think of it? Active investment, you're constantly tripping over the lexicon of it's overvalued, it's undervalued, it's too cheap, it's too expensive. Where do I stand? I stand in calling that out as it's prejudice. This is name calling. I prefer the clarity, if one can dare to suggest clarity of trend. So, like there is clarity. If you go 10 years of price data and if the trend is not positive, then there's a big question mark about whether the host underlying operating company is actually alive. And we live in a time when maybe upwards of 10, 12% of listed stocks might actually be conceived as being zombie companies, that they're being kept afloat by the current, or were being kept afloat by the current very low level of carry, of how much that you could have lots of debt. And because the servicing of the debt was nominally low, that you could persist rather than be forced into Schumpeterian kind of creative destruction. But yeah, I push against it's overvalued, it's undervalued. That is particular to stocks. I think, again, you can have qualified opinion on stocks being expensive. There's another term. Cheap, there's another term for the lexicon. It should not apply to currencies. I cringe when people say the dollar's expensive. On top of that, again, name calling and this prejudicial calling out. What's the biggest sin? It takes you away from engagement with trending assets. So don't tell me your prejudice of it being cheap or expensive. Just confirm to me that it's rising. If it's rising in value, you've got to convince me profoundly that I shouldn't be involved. I'm more than happy to buy the most expensive, the most silly thing, if it is price trending positively. Now, the amount of money I might allocate to that will be remarkably different depending on whether I think I can reach a qualified opinion on the nature of the business. So like everything, it's a mix. It's kind of why I've got 30 years experience and I can't switch my mind off, even being on a tiny tropical island in the middle of the Caribbean. I think I've labored long. So the question is, if there's no trend, there's no setup. If there's no trend, there's no trade. But that's a very different thing from if there's no trend, there's no conscious awareness, there's no curiosity. There's a curiosity for everything. And in many instances, the challenge of a risk taker is to build a warehouse, a theater of dreams, of expectations of how the future might end up. And each day we're a day closer to trying to determine whether that vision of the future makes any sense. And it only makes sense of those ideas that you've constructed, with a team of really bright, smart people doing orthodox things, i.e. reaching out to investment banks, bringing in their industry and specific commodity experts from agriculture to hard metals, to pharmaceuticals, to supermarkets, having that synthesis of views, and trying to reach an understanding of the mind with regard to imbalances and how they might reflect themselves. The challenge is to have all of that. I'm not saying this is an easy business. You sit back and you're like, call me when there's a trend. That's if you do that, then you start with the disadvantage that without knowledge, I'm talking about, think of the warehouse as being a factory of knowledge that you have specifically furnished with your intellectual endeavors. Without that, you're starting with very small risk positions and pursuing a trend, saying, I don't know anything, but it's going up and I'll buy things going up. And if the trend persists, I'll add to it as I get more confident. What I'm arguing is entirely different. You commit. The first thing you do is have an opinion, and you test it against the opinions of others, and you conceive of contentious narrative. But then importantly, you put it to one side and you wait. And as you wait, you conceive of other contentious narratives, and you wait. And it's like Shakespeare's The Tempest. We don't see the wind; we feel the wind as it affects our lives. And I was an investor whereby these mysterious forces, I was constantly watching. When I was at university, I didn't drink, I didn't smoke, I didn't do drugs, I didn't have girlfriends. But I was fascinated by the action. At the end of the evening, I knew everything that happened. I was watching. And so for me, markets are this never-ending drama. But as I say, for it to be an active participant, the hard part of the job, the day-to-day grind, is building and filling the warehouse with your imagination. And then the discipline is knowing when to pull it down from the top shelf and plug it into your portfolio. Don't name names in terms of naming people who don't understand money. I guess I could name institutions. I feel like there's been, I feel like something changed. I think most people with my level of experience would tell you something's changed with regard to our understanding. Things are constantly, knowledge is constantly evolving. There was a time when we thought the earth was flat, that the sun rotated around the earth. Things, that's a long time ago. Our knowledge and our understanding is subject to being turned on its head. You go, that explains it. And what I'm getting at there is a macro orthodoxy. By orthodoxy, I mean a means of understanding the engagement with risk, an understanding of what's supposed to happen. I drop this pebble into the pond, I get ripples. What if you drop the pebble and there are no ripples? We've kind of gone through an extended period like that. Now, for sure, you could go through a day, you could go through a week, maybe a year. Again, observation points, not long enough. I want to say we've gone through the best part of 25 years where the economic understanding has been turned on its head, where all these pebbles are not creating the ripples. And by that, I mean, there are, and regardless of today's circumstances, they are still majestic intellectual thought pieces. But I'm thinking Kindleberger, Manias, Crashes, etc. Was a wonderful template, evidently used by some of the biggest operators in macro, swinging big portfolios and going in for the kill, looking for opportunities, positioning themselves ahead of the drama. And they were taking pages out of Kinderberger. And you might say that the authorities on the other side, the IMF, who then come in and then they have a playbook themselves, all kind of complies with this understanding of the economic landscape and universe. And they haven't. That is ladies and gentlemen, that is the 5 to 4 o'clock in the afternoon flight heading to San Martin or maybe San Juan. I am directly underneath the flight path. But that economic epistemology has not really applied. Again, this is where I get immensely frustrated. I don't know what the sovereign nation of the United Kingdom is meant to do. I'm sympathetic to what they did in the immediate aftermath of the great financial crisis. When 2 or 3 years subsequent, you had the European sovereign bond crisis and you had a new British government. And they said, hey, listen, our priorities, we've got to keep our financial house in order. The bailing out of the banks, the weakness in tax revenues from the prolonged economic recession, our revenue take has withered and our commitments to the people have increased. And so our deficit leaves us rather looking somewhat vulnerable. And so they reined in their spending. They shrunk the state. We can call that austerity. It's very painful. It's politically very unpopular. People lose their jobs. Social services are cut. Did it achieve anything? Not sure. I'm not sure that there was any relationship established between the government debt levels to GDP of the UK and financial misdemeanors in terms of where the domestic sovereign bond market were traded. Domestic sovereign bond market traded in a bull market. I'm concerned that today they're embarking on the same crunching reduction of spending to the tune of $50 billion when the previous strategy didn't evidently work. And when we find ourselves in an environment where economic growth for countries like the UK, well, particularly for the UK has hardly enjoyed any economic growth, been troubled by the inevitable destruction of Brexit. But you had 50 years up until 2008 where you had you had a linear trend and you had economic cycle oscillations around it, where economic growth was like 2.5%, 2.6%, 2.7%. We've got nowhere close to that in the last 15 years. Again, something's different. And I'm still waiting for people to tell me what it is. I can offer you what I think it is. I think it's the engagement of mercantilist nations, principally China, owing to its size. I think as they've grown in size and scale and their determination to manage their exchange rate, their determination that they win. The global trade's meant to be a process of mean reversion, that the winners, who are the winners? The winners are the ones who are the recipients of all of our money. We transfer our wealth, they transfer goods and services. That wealth that we transfer to them is meant to make them evidently richer, to feel better about themselves, to encourage them to spend more, to demand higher wages because their expenses are going higher. And as they become more and more better remunerated, this is the mean reversion, as as they no longer enjoy perhaps the cost to productivity advantages of the past, then they lose some of their competitive strength. But at the same time, they're this beacon of demand for the rest of the world. And so the pendulum swings, and in the context of this discussion, the pendulum would swing from Asia back to the West, and we would be more productive, more cost competitive with them. And so trade deficits in the West would suddenly become balanced, and we might see surpluses. So trade, as it has always been conceived, has been conceived of as a pendulum. And we hit generational crisis points when big major economic agents cheat. France, which was more major in the 1920s, and America, which was certainly major, cheated in a manner which I recognize the Chinese in cheating. Cheating, I mean, in not allowing that pendulum to swing fully. And so the Chinese, what they've done is they have effectively redistributed. They've robbed their household sector of rising prosperity, which is their right. And they've taken it away from them, and they funded very impressive infrastructure projects, but infrastructure projects that destroy wealth in that the costs outweigh a generation of utility benefits, the benefits of moving people quicker across continents. And at the same time, having enriched the center, they've also taken $5 trillion, a third of GDP, and they've taken out of the economy. They've used that to manage the external price of their currency. And then they've put it into Western liberal markets with good contract law, and more importantly, with liquidity. They've bought $5 trillion of treasuries, especially in that period, 2000, the noughties, the period of the noughties. And in doing so, our domestic financial systems just were overwhelmed by that. Overwhelmed in the sense that the domestic investment needs of the continent of North America are historically modest today, and they're fully met and covered by domestic savings. So when you transplant another $5 trillion into that system, you turn the probity of money upside down. Money becomes mad. Money loses an anchor of reasoning. And so whilst I don't have great words to say about the Federal Reserve, what we can certainly say is that I would attribute fictional wealth, the fictional wealth of rising asset values, I'd attribute it more to the less than benign forces of mercantilist nations in the East than I would do to name calling the Federal Reserve and saying they don't understand money. Cryptocurrencies, it is this lamentable drama from, what is it called, the crypto broker, FTX, or whatever the acronym is. Is that a Lehman moment? Is there a systemic razor's edge that could aggravate matters further? First, kind of wise heads are quick to say that the value of Bitcoin et al. Recently was trading no more than $1 trillion, which in the context of US stock market being 25 trillion, US treasuries being 25 trillion, US real estate being 35, 36 trillion, gold being probably, 8 trillion, that they want to say that it's a drop in the ocean and therefore pull away from the systemic adjective. And I accept that. There's a less quantifiable phantom, which is that crypto arguably was being used as collateral and therefore supporting the take on of credit and credit leverage to support speculative build or let's say productive build. Like there was a crypto engagement, a new frontier, if you will, in bank lending, having taken the government out of the banks with regard to the non-sovereign nature of the Eurodollar offshore banking system. The great tease and the great hope of blockchain technologies and crypto et al. Was that maybe we could take banks out of the equation with regard to credit creation. The recent demise of crypto is, I think, very much aligned to that collateral supporting real world credit projects, higher risk credit projects that had to go seeking the collateral of crypto to make it happen, who were denied the credit by more conventional forms of credit expansion. And as the Fed or the inevitability of the economy slowing down post-COVID, they've been caught that the first credit projects to fail within the real world are the riskiest. And the riskiest physical and speculative projects in the real world are the ones aligned to crypto collateral. So if crypto is $1 trillion, I think actually the credit universe around it is arguably much greater. But I'd have to guess. I don't know if that's 5 trillion. I don't know if that's 10 trillion. I do know that rehypothecation, that you can start with $1 trillion and rehypothecate it many, many times over. So it could be $25 trillion, but I have no way of demonstrating them. But outside my message is I am sympathetic to those who say it's not a Lehman Brothers moment, but I would take my time in forming that judgment. And again, I'd have my goggles and I'd be looking at trends and resulting trends over the next few days, few weeks to see. I mean, I've been hesitant, reticent with regard to engagement with crypto because that was my fear, was the credit that it was underwriting, anything that was offering you yields. I'm not saying this in a kind of gloating manner. My principal concern with the crypto universe was that it was offering yields in excess of 10, in many instances, much more than 10%, in a world where global interest rates were zero, where we had trillions upon trillions of sovereign bond yields with negative yields. And so anything that was actually enticing you with 10, 15% nominal yields, I was concerned about the credit biting you in the ass. And that's what's happened. Who is my favorite band? I am eclectic by nature. I don't believe in favorites. I like music. I've got a music lesson in an hour, a guitar lesson in an hour. And I have to say, learning, I had consigned myself. I said, I love music, but I'm not musical. We label ourselves. Be careful if you find yourself doing that. I challenged myself and I bought a beautiful bass. And you know what? And bass is rhythm. We can all, you can tap here, tap your chest breastplate. It makes such a great resonance. And when I got back to St. Bart's, we had a lesson, and we were playing The Clash. Should I stay or should I go? And the simplicity and play, and then when someone else plays on top, when we talk about synergy, like 1 + 1 = 15. That's what it's like when you play. Just adding a soundscape on top of a bass, boom, it explodes. Favorite bands. My favorite band of the moment is DC Fontaines, a kind of punk band out of Ireland. I think, again, I was shading some lyrics. Lyrics within songs again, are little clusters of dopamine that just come in and just kind of open up your conscious being. And when your conscious being opens up, again, first thing I do is I try and look forward. So I think there's lots of great lines within the Fontaines. It's youth, it's happening, it has attitude, makes me feel even younger. But it also opens the pathway of the neural pathway, and just the merest glimpse of resolving a lot of the REM traffic within your mind. And my REM traffic is typically what happens next. Jim Rodgers doesn't know me, but I recall, and Jim, good on him. He's in fine form for a man who's must be in his mid to late 80s. I commend him, and I commend everything he's done. A remarkably wise agent, economic agent. The Soros is, I think, first hedge fund partner. When I say I don't say that to many people, but I recall coming off a Bloomberg show in New York in the old offices, so that's the agent somewhat, and I was trying to talk. This is actually appropriate for where we are, because it recounts a story narrative line that I had from the 1970s, and people are very quick to align or assign today and today's elevated prices to the 1970s, and I think there's an error there. I used to talk about Soros in that kind of one of the first major trades. The Soros fund, the quantum fund, was 1969. One of the major equity trades that they had was buying into banks, going very long, commercial private banks. And the background, so again, here we are conceiving of narratives that we're going to store in the warehouse. And the genius of it is to have the curiosity to go, oh, banks. You think, yeah, banks. Well, think banks 50 years ago. Right? Banks had been sequestered, had been denuded, had their balls cut off by culture and society, that had seen the damage wreaked upon society by their bankruptcy many decades before, at the very start of the 1930s. And so our culture, our pop culture, had decided we wished to defang the banks. We had to, we set Glass-Steagall? Was that the Glass? Yeah, Glass-Steagall. We had to defang. We had to say, hey, no more casino betting with the public, because we underwrite you guys. You're so precious. You give us mortgages. None of the crazy stuff. And so for the best part of 40 years, 1930 to 1970, banks became sleepy, really, really sleepy, low risk, utility-like institutions. And Soros et al. Could see, again, I love cycles where the protagonists die. I don't wish them to die, but I'm talking about the lots of observation points, the very long march beat of time. And in that instance, the forefathers, the ones who bore the original sin of the bankruptcy, them and the Federal Reserve, the bankruptcy of the banking system in the 1930s, they largely had passed on, and there was a new breed, and they were doing they were doing MBAs. That's why I got mortgage-backed academies, MBAs, management, Bachelor of Arts studies. And they were coming going, dum-da-dum. This is your 4:15 flight to San Martin taking off. They were sitting there going, after their studies at Harvard, Yale, etc. I want to take risk. And Soros et al. Could sense that there was change coming. And so they bought big time. A utility, an institution prices a utility that's about to rip off the mask and like Superman and become a master of the universe, take lots of risk and be rewarded for it. At the low point of debt to GDP, debt approximately 1x GDP, today 4x, asset prices on their ass. Again, here I am tropically. Virgin, Richard Branson, he buys an island. Islands are overrated. Private islands are overrated, but he buys an island. The seller wants $1 million. They agree $150,000, right? That's the bottom of a profound cycle where I metaphorically, I can see dead people in our future, but you actually see the dead people are in the past when you're at the bottom of the cycle. So that was a story which I was recounting on Bloomberg, and Jamie rather was incandescent with rage because it was Jimmy's idea. I do hear on the grapevine that's always Jimmy's damn idea, but and so Jimmy was hitting me. This was back when you had Blackberries. Oh, how dare you? You're an ass, and you tell that story. You don't tell it, with the proper accreditation. So there you go. It was Jimmy's idea, but nice story, and it worked out. Dollar wrecking ball. Let's wreck this ball, which is to say, I'm verbose. Don't give me any more airtime. Let's bring the show to an end. We've discussed trends, the primacy or otherwise of trend, or the trend is an attempt to moderate some of the intellectual exuberance that comes from an orthodox analyzing of businesses and economies, and kind of the conceit and the arrogance of that intellectual plaything has to be tempered by the reality of trends. And so one of the big questions today is the dollar. Has that trend played out? For you guys listening to the audio, you're gonna miss the fact that I'm going to share my screen. I'm like a penny that loves the pocket of the priest. I think that's not really making much sense, but I want to demonstrate to you, this is not financial advice. I want to demonstrate to you the resources at hand. I like going to this page. It's a free page. I am not sponsoring it. I am not being paid for these comments, but it's kind of one of my go-to places. I've been away and I want to engage with the market. It's a nice quick thing. I see a combination of equity indices, commodities, and currencies. So, and somewhere at the bottom here, I know, is the dollar. And so that's where we're saying the dollar wrecking ball, is it over? So forgive me, those of you who are just listening to the audio, but I'm going to show that heavens, beginning of 2022, the DXY, the Dixie, was kind of trading 94.75, and late or mid-October of this year, it was trading 114. It's a big move over the course of heavens. I'm just looking. I'm looking at 1 year's worth of data, but then we've just gone boom, boom, boom. From 114, we're down to 106, and wrecking ball, the trend's over. So first point to make, this is not enough data, but even within the confines of this limited data, you kind of go looking. So kind of, I was going to say pro tips, but I mean, protein. I mean, if you take, this is your protein powder tip after you've been working out. The first major significant thing is the substantial low recorded before the substantial high. So the substantial high is easy. That's the last high. The last high is, say, 114. Again, subjective. What was the substantial low? Because there was a low at 108. I'm going to dismiss that because there wasn't enough time spent there, and the correction itself wasn't that great. And I would focus more either on the period, which was, let's call it August, where we fell 108 to 104, or possibly May, when we fell. It's another flight leaving St. Bart's. May, when we fell 105 to 102. So whilst the dollar has been horrid the last week or so, I kind of don't really care in terms of trend wise. It could trade at it could arguably could trade at 100 and I'd still be yawning. We're very insistent, however, that we, rather than looking at daily, I mean, at least we're not looking at hourly. At least we're not looking at 5 minutes. You people are trying way too hard. Let's go weekly. Adverts everywhere. Weekly, and where we look, heavens, where is, I mean, I can't even, so we're kind of somewhere back in, I don't know, 2017. And again, well, that's kind of informative, because what you see is that prior to this year, there was a ceiling on the value of the dollar. The ceiling was round about 100. And then this year the ceiling was broken and we exploded. So it exploded higher, 100 to 114. And what I'm saying to you is, it's typical. You try and position yourself on the first breakout of the rooftop garden. But commonly it comes back to the breakout level. So I wouldn't be surprised if we come back to the breakout level of about 100. But just be careful, guys, because let's go even further data. I think in this environment, I think we're going to see 120, which was the highs recorded during the problems of the Asian tiger economies imploding, the problems brought on by the tech bubble bursting and lots of dollars being destroyed, and therefore making the last remaining dollars more valuable. That was when we were last trading at 120. You see what I mean? It all sounds kind of nonsense. So anyway, the nonsense hour is over. I've managed to regale you with stories in the absence of Mr. Sweeney within the secret old-fashioned lair in St. Bart's, above Eden Rock, way too close to the airport. The tribe, the asset capitalist members, those of you who buy the caps, I love you. AssetCap.com. Those of you who give us 5-star ratings, reviews for the audio, I love you. Those of you who take the time to pen comments on YouTube and to thumb it up, I love you. So you keep being you, and I'm going to keep loving you until next week. Our paths will collide once more. Thank you very much. I am Hugh Hendry. Hendry_Hugh, I think, on Twitter. Hugh, whatever. See you next week.